Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB. I'm Andrew Gagan. Thanks for joining us as we round out this Friday and the week, and not a great way to finish what has proved to be a very volatile week. In fact, shares tracking for the sharpest one-day fall in almost 2 months. There's renewed clashes between the US and Iranian forces sent oil prices higher and of course clouded the outlook for a peace deal. Although President Trump has said that while 3 Navy destroyers were attacked, he told reporters after that the ceasefire was still in effect and sought to downplay that exchange. Now that said, the S&P 500 futures are up 0.25%. Very different story what has played out here locally. We are taking a look. In fact, we don't have our graphics, so I'll tell you what's going on. Certainly as far as the S&P ASX 200 is concerned, off 1.4%. As I mentioned, the worst day in 7 or 8 weeks. And sector-wise, 10 of the 11 sectors finishing in the red. The outlier there being tech. Those stocks are higher today, perhaps off that buoyancy we're seeing on Wall Street. But it is those interest rate sensitive stocks that have been hit hard today. REITs off around 2.5%. Financials, a similar margin there. Utilities 2%. Energy has also come off today, interestingly, as well also. And just in terms of, obviously we had that the RBA key decision this week. Now Westpac, it's the latest bank to actually update its call on rates. It's saying that it shifted its next hike from June, which is the next meeting, to August and September. So 2 more hikes it's expecting, but not for the next meeting, as that fallout continues from the Middle East and the effect it's having on inflation. Let's get to the themes of the day, and well, let's call it Friday freefall. Ceasefire cracks and payrolls watch. We don't have those titles up for you, but that sums up what we're seeing at the moment. Payrolls, because we do get a key non-farm payrolls report out of the US tonight, and that may well give us a good indication of which way the Fed is going to go in terms of its rates. Well, let's quickly just wrap up the top stories of the day. Macquarie has posted its second biggest annual profit on record, boosted by strong growth in its commodities and markets division. QBE Insurance reiterating its full year 2026 outlook as it's held its AGM today. REA Group's third quarter revenue jumped 11% as it slashes cost guidance, and residential yields surged 14%. Block lifting its full year profit guidance after smashing first quarter earnings. News Corp third quarter revenue rising 9% to $2.2 billion. All right, well, let's get across those market moves and also what's going on in the economy at the moment. We are joined by Shane Oliver, Head of Investment Strategy and Chief Economist at AMP. Shane, welcome back. Good to catch up,
Thank you.
as we normally do on a Friday. So lots to talk about, of course. Let's start with what we're seeing in the Middle East. So I've just quoted President Trump there saying, look, nothing to see. That the ceasefire remains in place. Yet, of course, we've seen that market reaction here. Where do you think we're at? Because clearly the US market has moved on from the war.
It certainly has, and I think the US market has moved on for a couple of reasons. One, it hasn't seen any impact on the US economy yet, and secondly, profits have been dominating with that huge surge in tech profits. They're up almost 60% for the year to the March quarter, and the overall profit growth is coming in at 28%. You know, just go back 4 or 5 weeks ago, the expectation for this quarter was for profit growth of about 14%. It's coming in at double that. So those things have dominated, and until we see much of an impact on the US economy, I think that probably remains the case. That said, there's still a problem down the track, and I know Trump keeps saying that they really want to talk to us. We've had some really great talks. Peace is imminent. The Strait will reopen soon. Blah blah blah. I mean, we're going in circles on this. He seems to forget that he said that only a couple of days ago, and he keeps repeating it. And that keeps sort of keeping a lid on, I guess, pessimism to some degree. So other markets are a bit more sceptical. I think our market is a lot more sceptical, and we don't have the profit support that they do in the US because we don't have the AI tech exposure the US share market has. So that's why we've been a lot more vulnerable. than the US market has. But I think the situation in the Middle East is still messy. I think Trump remains under immense pressure to cut a deal. He has not followed through on his threats to start bombing again, but he keeps making that threat and then doesn't follow through on it, which tells me that he wants to stay on the off-ramp. American households are not happy with what he's doing. Only a third of Americans support the war. His approval rating is particularly low, particularly when it comes to the economy and inflation and cost of living and those sorts of things. So I think he wants to stay on the off-ramp to wind down the war. But, of course, the Iranians are stringing him along. And, of course, that's acting as a bit of a brake on all of this. So I suspect he will cut a deal. But as many people say, it may not be that much better than the one Obama signed, 11 years ago now. So we end up back where we were then without achieving a lot, despite billions of dollars spent on missiles being blown up and a big loss of life.
Yeah, don't tell President Trump that his deal's no better than Obama's, given what he said about that one.
I'm a very nasty person. You're a very nasty person. Where are you from? Australia. Well, I hate them. Blah, blah, blah.
You've been listening in. Shane, now, of course, also weighing on the market here is the prospect we're going to get more rate hikes. Of course, the RBA is somewhat out of kilter with what we're seeing with global banks, central banks that is, although more sort of have that tightening bias. But, I mean, clearly it is, the bank's concerned about inflation here. Have we seen the full inflationary effects of the war pass through the Australian economy yet?
I don't think we have by any measure. There's three impacts from a supply shock like this on this scale. One is the direct impact, and you see that on fuel costs. So we've seen that. It's been partly offset by the fuel tax cuts. The second impact is the second round effects. So oil feeds into a whole bunch of things like paints and toilet seats and helium, neon flowing from the gas and so on. So there's all sorts of effects, airfares, all sorts of effects yet to show up. They're the second round effects. And then there's the third round, which is inflation expectations might get a boost as ordinary workers say, well, inflation's gone up on the back of all these things. We want a better wage rise, and companies pass that on, so you get that spiral sort of occurring. So I think so far we've just seen the first round effect, the trim mean or the underlying rate of inflation in the last quarter, in the last month that we've got data for was March. It was 3.3%, 3.5% if you look at the quarterly numbers. I don't think that reflects those second round effects yet, and we're yet to really see much of a flow on to inflation expectations so far. But obviously the Reserve Bank is worried about those second and third round effects, and that's partly why they're hiking. And I think, mind you, I mean, lots of central banks have left rates on hold, but there was one overnight that did hike, and that was the Norwegian Central Bank, and they hiked, I think, for very similar reasons to the RBA. Inflation was too high, and they're worried that they'll lose credibility. Their inflation target loses credibility if they don't respond, and obviously they're worried about the flow on from the situation in the Middle East. So I think we've so far just seen the first round effect. There is still more to come.
All right, well, given that then, Shane, what is the outlook for the RBA policy, given, as we know, they hiked for the third time in a row this week? More definitive vote, if you like, amongst the board, 8-1, so there was one dissenter. Given that, I mean, what's the likelihood they will pause at the next meeting and perhaps then resume hiking?
Look, I think they will pause, and I guess for some time now we've been of the view that there would be another hike, or we penciled one in anyway for August, and that we thought that they would pause in June, having moved three times in a row. And I think that's still the case, that they want to pause from here. There was sort of comments to that effect from the governor and in the statement that monetary policy is now in a good place, having hiked three times. So I think they'll want to sort of sit back and see. Then we'll probably get one more in August, which is what we're allowing for, because I think they'll still be worried about inflation in 3 months' time. But that'll probably be it. I think as we go through the latter part of the year, we'll see lots of evidence the economy is slowing down and that households are really struggling under the weight of all these things, higher interest rates being a big part of it, and that will therefore enable the Reserve Bank to leave rates on hold. And then as we go through next year, we'll probably be looking at rate cuts. That said, I mean, I've come to the view the Reserve Bank is doing the right thing. I initially thought that maybe they were getting carried away, but as time went on, and when I just thought about the 1970s, which I sort of was a kid in, I realised, they got to respond here, and there's no way you want to let happen again what happened in the 1970s when they responded too softly and inflation got out of hand, and then we ended up having to have two very serious recessions in the early 80s and early 90s to get it back under control.
So that's monetary policy. Shane, next week, the focus on fiscal policy, the federal budget handed down on Tuesday night. Look, lots of leaks as goes on. The focus is very much on tax, particularly its treatment for investors. What are you looking for? And is fiscal policy working with monetary policy at the moment?
Well, not if you look at Victoria and WA. I mean, WA, if you've got two kids in high school and all those other handouts, you might get $700 out of it. I mean, that's direct contradiction of what Michelle Bullock was asking for on Tuesday, or pointing out on Tuesday, that if you go providing all these handouts to households, you just make it harder, just puts more upwards pressure on inflation, more upwards pressure on interest rates, and mortgage holders end up paying for it. So I think they're not cooperating. The budget, I'm a little bit more hopeful. We have heard that rumour or that leak that there'll be $200 to $300 there. I mean, that's relatively soft, although I don't know quite why I deserve the $200 or $300. I mean, it's like you got to pay the tax, then you get the $200 or $300 back. I don't know that should be the case. It should be targeted to those who really need it. But I think the key in all of this is that the government provide net spending cuts. So you can make those payments to households, but on the flip side, you've actually got to have more in the way of spending cuts or spending savings, so that net there's actually a reduction in spending. That, I think, is the key in all of this. The Treasurer, I think, this morning said there would be a reduction in net spending, and that was my reading of what he said. I know he said $64 billion in gross spending cuts or savings, but then they could come out with $80 billion worth of spending elsewhere, in which case there's a net stimulus of 16 billion being pumped in, but he said there would actually be net spending cuts as well. If that's the case, then I don't think I'd be too concerned about that $200 to $300 payment boosting inflation. I think the key in this budget is to see net spending cuts. Now is the time for the public sector to get out of the way, make more room for the private sector, and at the same time, we need to see the government deliver on real tax reform, not just fiddling around with capital gains tax and negative gearing and trusts. I think we've got to see real tax reform, which enables lower income tax rates on a fundamental basis, and then also we need to see productivity improvement. Less red tape. Obviously, a lot of that is in the hands of the states. In other words, it probably requires more incentives for the states to deregulate, and also more incentives for businesses to invest. So they're the things that I would like to see in this budget. Of course, time will tell as to whether we get them or not, but hopefully it's not just going to be another trick with smoke and mirrors and things like we often see in budgets.
Yeah, you would think Australians would see through that, but as you point out, we'd certainly like to see something on the productivity front rather than just cuts. We shall see, of course, on Tuesday night. Shane, you think, if the government are not going to be bold now, then when are they, given the mandate they've got?
Well, that's right. Now is the time to do that.
Yep.
Big mandate. Next election is 2 years away. If you leave it till next year, it's going to be too late, because we're then banging up against the next election.
Shane, terrific. To wrap the week, thanks for joining us on AMP.
Oh, pleasure. Thank you.
Well, let's now turn to our stock of the day. I mentioned it earlier. Macquarie out with its results, and which was better than expected. And our experts, Andrew Coleman from Team Invest and Jonathan Takadina from MPC Markets, gave us their view.
I'm a shorter-term trader. Okay, so I was in for, I forget the exact levels, maybe about the 220, but I used a bit of leverage on the trade, so it hits my target. I knew that the results were going to be good, but I just know the Australian market, when stocks break out the new highs, someone comes in and just smacks it on the head. So I just knew that, and that's from experience. So I just knew to take that high print on the open. If it runs away with you, you can always jump on board. But I usually find that there's that morning print on good news, take that and reassess, and that's what happened today.
There were really four key reasons why, as long-term value investors, the banks as a whole are not particularly exciting to us. And they come down, all of them, to the reason that they're far riskier under the surface for an equity investor than at first they appear. The first is that the nature of the business model converts short-term liabilities into long-term assets. And so that's fine when things are steady and normal, but anytime the economy or the world goes through a bit of an exogenous shock, big changes, they become overly exposed if they got it wrong.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring, or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
Let's turn to what is ahead. Now tonight, that key unemployment data out of the States, but also the non-farm payrolls. Now that is going to be important. It is going to inform the market just as to what the next move from the Fed is likely to be, whether they maintain a hawkish or a hawkish or a dovish bias, I should say, just as far as rates are concerned. Obviously, there's still a lot of push there to cut rates. Very different story to what's playing out here, of course. Now, next week, as we were discussing, Tuesday night, Fed will budget. So once again, key as to the economy and what is ahead and what the government has planned. Lots of leaks there, particularly in relation to tax. We also, in the States, get the latest Senate vote on the new Fed chair, plus US inflation on Tuesday, retail sales in the US on Thursday, and locally earnings, among them Life 360, CBA, Aristocrat, and Xero. So let's recap where we're likely to finish on this Friday. Now, unfortunately, we don't have graphics up, so we can't show you what we're seeing on the CBO 200. I can tell you on the S&P ASX 200, we are off close by 1.5%. To finish the week, virtually unchanged. And in fact, year to date, we are now unchanged. So a lot of volatility this week in terms of losses and gains on the local market. So that's where we're ending up. Nowhere, it would seem. As that uncertainty continues in the Middle East. A quick look at the best and worst in today's trade. On the best side, Light and Wonder, that's almost 13% higher off the back of its recent update. Purinex again featuring there, up close to 7.5%. Block also higher, and Life 360, which I mentioned there, is going to report next week. News Corp also doing well off the back of its results as well, whereas negatively, Tabcorp caught up in Austrac investigations in relation to money laundering. What it's doing about that is down another 15% today, and also some of the uranium stocks, Silex among them, and Deep Yellow. All right, that is the COB on this Friday. Thanks for watching and listening, and join us again next week.